let's come back. In the previous session, we have discussed about the first few sections of this accounts of companies. And just to refresh, we started by discussing our topic accounts of companies. And in this, we have discussed the general weightage of marks based on the past examinations. And one look at it, it is very clear that the minimum average marks that are asked are somewhere around 5 to 6. And the importance of this chapter, if we can have a look at it, there are questions where which are asked for 7 marks and 10 marks in couple of attempts, and these 7 or 10 are out of 70 marks. So that itself signifies how important this chapter is from, and that significance is reiterated even in the weightage that is given in the new syllabus of ICAI, where we can see that this along with 3 other chapters are given a weightage of 30 to 35%, all that we have discussed. Now, in the previous session, we have covered basically what are the types of accounts that company needs to maintain under section 128, 129. We have covered about schedule 3, we have covered about accounting standards requirements, and we have also covered this one of the very important chapter, one of the important section, that is 129A, which is applicable for unlisted companies. Now let's continue from this reopening of accounts in this session. Now, let me open that concept. And if you analyze the methodology that I'm following here is, we are taking this ICI material as the basis, which is summarized. Whatever you are seeing on the screen, the material is nothing but a summarized version of your ICI material. And wherever I can summarize for the convenience of the students, that is what the summaries I am presenting through these kind of charts. So let's go in the same mode so that whenever you want to reconnect back with your ICA material, you will, that is what we have been highlighting. You can even highlight, use the markers, highlight it for your future reference. And we do have summaries for your quick understanding and the, getting grip on the topic. So now, opening this material on the section 130, which deals with reopening of accounts. See, to give a summary, when it comes to revision of financial statements, there are 2 sections that are involved in it. One is section 130, and second one is section 131. Both these sections talks of revision in the financial statements, revision of financial statements. Now, then why do we have 2 sections? Now this section 130 talks about mandatory. That is where you are required to modify the account. You are required to revise your accounts, the financial statements, because of the order by the tribunal. And in section 131, it deals with voluntary revisions to this financial statements. Now, let us look at section 130 first. That is, which deals with the tribunal's orders for reopening accounts. And from your examination perspective, this is the most sought after question. This is what he has been asking at multiple attempts. I will take you through the questions. But first, let us try to digest what are these compulsory revisions where you are asked to revise your accounts because of the order by the tribunal. Now, who is complaining to the tribunal? If you look at it, wherever this central government, the authorities basically, either the central government or other regulatory authorities like income tax, SEBI, any other statutory regulatory bodies or any other concerned person, wherever these authorities, statutory authorities including the central government, they believe that the accounts that were prepared were in a fraudulent manner, or the affairs of the company were mismanaged relating to accounts, then they will submit their application to the tribunal, and the tribunal will see the merits of it. And if the tribunal believes, yes, there is a case in the application, then they will give the notice to the other applicants and the other parties, and they take the representations. The tribunal will take the representations into consideration, and if they believe that the contention of these authorities is correct, that is, either the accounts have been prepared in a fraudulent manner or the affairs of the company were mismanaged, then in both the scenarios, they are going to pass an order asking the company to revise or recast the accounts. So this is, and once you revise or recast, that revised account shall become final. Now, to quickly taking back to it, what are this 130 talks about? This 130 talks about wherever these authorities are of the view that either the accounts prepared by the company are in a fraudulent manner, or the affairs of the company were mismanaged relating to accounts. In both the situations, these authorities, including the central government, may make an application to the tribunal. And the tribunal, the moment they receive an application, if they are satisfied that yes, there are grounds either for the reason 1 or for the reason 2 that we have talked about here, then they are going to serve a notice to all the concerned people, and they take the representations whatever are submitted by the company into consideration, and based on their due inquiries, if the tribunal believes yes, the reasons are justified, there is a need for revision, then they will pass an order. So this order is passed by the tribunal, and once the tribunal passes this order asking the company to revise or recast, it is mandatory on the company to revise. And whatever the revision you are making, that will become the final. That is, the earlier version of financial statements will no longer be valid, and the revised accounts, revised financial statements shall be considered as valid. Now, as I said, when this question is being asked in the examination, what is the point on which majority of the questions are being asked? Majority of the questions are being asked to highlight on the time limits. That is, whenever the tribunal is passing an order, or wherever this authorities are submitting an application, what is the time limit? Up to what point of time this people can ask order for reopening of accounts? If you look at it, the maximum period, mind you, the maximum period that for which they can apply for reopening of accounts is 8 financial years. So that is 8 financial years immediately preceding the current financial year. So to sum it up, the maximum period for which these authorities can request the company to reopen is 8 immediate preceding financial years. Now, only one exception to this time limit, that is, where if there is already a direction by the central government for maintaining such books of accounts beyond 8 years, where any investigation is in progress, or the central government they have made up their mind asking the company to maintain these books for more than 8 years, considering the current investigation or future investigations. In such cases, since the books of accounts are available for 8 years, they can always ask this company to recast their accounts for more than 8 years. In all other cases, the maximum period for which the order can be passed is only 8 immediate preceding financial years. Why only 8 years? This has linked to what we have discussed in our earlier segment. What is the maximum number of years? What is the minimum number of years for which the company is supposed to maintain their books of account, books and papers in the financial statement? So, since the point there was 8 years, and when you don't have the books of accounts, and since beyond this 8 years, how can you revise it? So this is linked to it. So to sum, this is what is this provision? To sum it up again, wherever the statutory authorities along the central government, they believe for two reasons: either the accounts are prepared in a fraudulent manner, or the affairs of the company were mismanaged, then they will submit an application to the tribunal, and the tribunal will go through the application, and if they also believe that yes, the reasons are justified, then they are going to give the notice, and they listen to the company. That is, they take the representations given by the company into consideration, and after due consideration of the application and representations, they are going to pass an order. But the only point is, the maximum period for which you can ask them to revise is only 8 preceding financial years. Now, this is all about compulsory revision. Now, let us look at voluntary revision, then we will look at the summaries and the previous year questions. If you look at voluntary revision of financial statements, which is dealt in the subsequent section, that is section 131. Now, in this, why is it called voluntary? The name itself is self-explanatory. So wherever the company believes that there were errors or there were non-compliances with regard to section 129 and 134, then they are going to make an application to the tribunal, and once the application is made by the company through their directors or through their representatives, maybe through chartered accountants or company secretaries who are representing the company, once that application is filed with the tribunal, then the tribunal will go through the merits of the case, and if they believe that yes, there is a genuine non-compliance of 129 and 134, they may pass an approval or they may pass an order allowing the company to revise their either financial statements or the board report of it, which is covered in section 129 and 134. But the point to be noted here is the maximum period. So the maximum period the company can submit their request here is only for 3 preceding financial years as against 8 preceding financial over here. So this is what is the difference between these two provisions. Now let's have a quick look at the difference between this difference between section 130 and section 131. Now if you look at it, in both the cases, mind you, whenever you want to revise your financial statements, you can do it only with the approval of the tribunal. So the approving authority is only the tribunal. But the only difference is who is applying to the tribunal. Say, in the case of 130, which we call it as a compulsory revision, the application is made by the authorities along with the central government. Whereas when it comes to 130, it is the company which is making an application to the tribunal. Then what could be the reasons for revision? Here, there are two reasons, as we have discussed. Either accounts were prepared in a fraudulent manner or the affairs of the company were mismanaged. When it comes to section 130, the reason is non-compliance of sections 129 and 134. And then the another biggest point of this is what is important from your examination. Kindly make a note of it. What is the period for which they can ask you to revise the accounts? Under compulsory, they can order you to as many as 8 preceding financial years. But when it comes to your voluntary, you can submit that request only for 3 preceding financial years. So this is the summary between this compulsory revision of accounts and the voluntary revision of accounts. And there is one more point which is important for you, that is this one. I'm marking it. That is this kind of application, this kind of revisions. So if I read it as it is, the financial statement provided further, that is in this, such revised financial statement or report shall not be prepared or filed for more than once in a financial year. So the maximum revisions permitted are only once in a financial year. That is what is the important point that we need to know. Now let us look at the questions, how it is being asked. Now look at this ICAI MCQ question out of this ICAI booklet. Now ABC Limited has its shares listed on a stock exchange in India during the current financial year ending, that is 31st March 2023. This SEBI has found some irregularities in the filings made by the company. SEBI had noticed certain irregularities. Accordingly, SEBI proposes to make an application to the tribunal for reopening of the books of accounts of the company. So who ordered here? SEBI has ordered for reopening of it. So therefore, what comes into question is section 130. Because it is an application is made by the SEBI to the tribunal. It is not a voluntary one. So section 130 would get attracted. Now, you as an expert are called upon by the SEBI to advise the earliest financial year to be quoted in the application for reopening. As we have discussed, these authorities can request under this compulsory revision for a period of 8 preceding financial years. So since we are at 23, now taking 8 years back, that is where you will end up with this 2014-15. So beyond this, you cannot ask the company to revise unless there is already an order passed by the central government for them to maintain the books of accounts for such a longer period. But in the absence of details, this would become your answer. The logic for this is 8 preceding financial years. That's all. Now let us look at the another question. The income tax authorities in the current financial year 22-23 observed during the assessment proceedings. Now see here, it is the income tax authorities, whereas it was the SEBI. So there is a change. Now they found the need to reopen the accounts of Chetan Limited for which financial year? 2011-12. But which year are we now? 22-23. So when you are in 22-23, maximum you can go back is only till 14-15, because that is the 8 preceding. But the income tax want this company to reopen the accounts for 11-12, so which is almost a decade ago, 10 years. So therefore filed an application before NCLT to issue the order for reopening the accounts. Now which section will get attracted? Since the application is made by the authorities, again the point is same. Section 130 gets attracted. Now under section 130, 8 years, 8 preceding financial years is what the maximum the tribunal or the authorities can submit a request or pass an order. Now he is asking, examine the validity of the application filed by it. The application is not valid for the simple reason it is beyond 8 preceding financial years. So the summary of all this is the most important point. So this is why I was asking you to take a note of it, and between these two sections this is what he is asking in multiple attempts. So and by just remembering that 8 years, the question may come in the objective form, that is MCQs, or the question may come for just 3 marks to 5 marks. Now let us look at another question. May 2019, 3 marks. It's the same. The moment you see any of these authorities, fix your mind. So he is going to talk about section 130. Now, during the assessment of it, same thing. But here, the year is 1920 and they want to open for 8-9. Issue is the same, just that the number of years are different here. Otherwise, it is the same. Now, they believe that there is a need to reopen the accounts, but only thing is it is beyond 8 years. Now, is that application valid? The answer is no. And the logic is again, what the application they are making is beyond 8 preceding financial years. So now, let us look at this voluntary revision. Just let's refresh and ourselves and then show it. Now under voluntary revision, who is going to make an application to the tribunal? It is the company. So when I say company, either the company or through their authorized representatives. So it can be even the professionals like chartered accountants, advocates, company secretaries, anybody, whoever is authorized by the company. And what could be the reasons for it? Section 129 and 138, 134, non-compliance of it. Then if the tribunal is satisfied, they will allow you to revise and recast your financial statements, including the board report. But the period here is 3 immediate preceding financial years. But as I said, like in this 138 years is the important one, and the point to be noted under this is you can't revise under this for more than once a financial year. Now, look at the question from examination. During half year ended September 22, the Board of Directors of New Era Limited has made an application. See here who is making an application to the tribunal. So, application is made to the tribunal, but who is making it? It is the directors. So, therefore, section 131 gets attracted. And once section 131 gets attracted, 3 preceding financial years is what you should keep it in mind. And the revision can happen only once a financial. Now, look at here. So, revision in the financials for the financial year. Which year they wanted to make this revision? For the 2020. Further, during the year ended 2023, the board has again marked this point. So, the board has again made an application to it. Now, made an application to the tribunal for revision, but this time it is pertaining to the year ended March 22. So, this is for the year 2022. See here. This is for the year financial year 2020. This is for the financial year ending 2022. Now he is asking, but they made the application twice, but each of it for a different financial year. Now you are required to state the validity of it. Is that application valid? The answer is yes, it is valid. The reason is the revision is allowed because the application is made, but it is for 2 different financial year. All that they said is you can't revise for 1 financial year more than once. That is what was the condition. But since the application is for 2 different financial year, one is for the financial year ending 2020 and the second one is 22. So therefore the application made by the board of directors will continue to be valid. So note that point. So with that, we are completed the first two sections of our second segment, that is section 130 and 131, which have been dealt with this revision of financial statements. Now, let's move to section 132. 130 we have covered, 131 we have covered. Now we are moving to 132. 132 talks about NFRA. Now, this is no doubt an important topic in a general perspective, and in practice, this is what now everybody is keeping an eye on. So, and every day you keep hearing the NFRA taking action on multiple auditors, XYZ, and punishing them with so many punishments. But when it comes to your examination, let me be honest with you, he's not been asking that frequently. So if you look at in the past, in November 20 and Jan 21, he had asked for that for 3 marks, and the question is also like a very vague one. So he's asking you to explain the provisions. That's all. So from the examination perspective, it is good enough you got a glance of all this matters. Now, let us come back to it. NFRA. Now, who had constituted it? I will keep highlighting this important points. Now, kindly mark a note of it. Who had constituted it? From MCQ perspective, it may come. So, it is constituted. This authority has been constituted by the central government. Indirectly, it's not a body of ICI. It is much above ICI. So, it is constituted by the central government. And what do they monitor with? So, these body is being constituted for providing matters relating to two things: accounting and auditing standards. Now, what are the duties of it, of this NFRA? They make recommendations to whom? They make recommendations to the central government on what? On formulating and laying down of accounting and auditing policies. So they are involved in laying this accounting and auditing policies, including the standards for adoption of it. So to summarize, they make recommendations to the central government, and second one, they monitor and enforce the compliance. So they monitor it and enforce the compliance of what? Again, the accounting standards and auditing standards. And third one, to oversee the quality of services rendered by the professionals. So whatever the services rendered by the professionals, are they in compliance with the standards? That is what they are going to look at it, and perform any such other functions. So other than this, so these are all the duties of it. If you look at it, making recommendations to the central government and monitoring and enforcing the compliance of both accounting and auditing standards, and again oversee the quality of services of professionals and perform. This is a residual one, so anything can else be added. Perform such other functions. But all these three are relating to accounting and auditing standards. Now, then how many members would be there in NFRA from MCQ perspective? Mark it as an MCQ. How many? What is the composition of NFRA? One chairperson and members not exceeding 15. So it is like chairperson plus 15. They could be part-time or they could be full-time, anything. But chairperson plus 15 is the maximum members that would be involved in this NFRA. Now, terms and conditions, nothing much. It's all about such terms, such conditions and all. I'm limiting our explanation to the examination perspective. So from examination perspective, maybe he may ask you in your MCQs about this one. That is, the chairperson, look at here, the chairperson and the members who are all among here, who are in full-time employment with this NFRA, they shouldn't have been associated with any audit firm. The reason is, the function of this NFRA itself is to review the qualities rendered by these professionals. So therefore, they are not supposed to have been engaged with any audit firm or including their related consultancy firms. For how long? For 2 years ago. So that is, for the past 2 years, they shouldn't be handling any assignments, or 2 years after ceasing this after ceasing to hold such appointment. I repeat it. What does it say? To maintain this conflict of interest, to avoid this conflict of interest, what are they saying? Who are the chairpersons here, including these members who can be up to 15? They are not supposed to be associating with any audit firm. When? During their course of their appointment and 2 years after it. They are not supposed to have it, because they are the people who are supposed to review and oversee the quality of professions. Hence the requirement of just to maintain the independence and to avoid conflict of interest. Now, what are the powers of it? They got the power to investigate, and they got and the powers of NFRA are such that once NFRA starts any proceedings, no other institute or body shall initiate or continue any proceedings. Once NFRA picks up a case, the other bodies will have to drop it. So that is the power of NFRA. And then when NFRA is calling the members or any of these professionals for a review, is it mandatory on them? The answer is yes, because they got the power of a civil court. So, and in what? So, in discovery and production of the books of account, in summoning and enforcing the attendance of any person, and inspection of books and registers and all, and issuing commission for examination of witness of these documents. So, for all this, the powers of this NFRA is equivalent to the powers of a civil court. So, then what is that they can levy? What are all the punishments they can impose on the members who are found to have been guilty of misconduct, professional misconduct? Now, they can impose two kinds of penalty. One is monetary penalties, and the second one is debarring them from the practice. Now, when it comes to monetary, it is if it, that again depends on who is that professional. Is he an individual or is he a firm? Now, or is it a firm? If he is individual, 1 lakh rupees to 5 times the fees received, or if it is a firm, 5 lakh rupees to 10 times. So, this is what the monetary penalty they can levy. Apart from that, they can also debar that member from practice for this much period. Now, minimum 6 months to 10 years of the period, they can debar them from being appointed as an auditor, internal auditor, or undertaking any audit in respect of financial statements, internal audit. So, any of these with that company and all for 6 months to 10 years. So, there is a monetary penalty and there is a debarring of membership. Now, from the future practice of it. Now, what happens if the member feels that he has been levied this penalty or he has been debarred, but the member feels the judgment is not proper, so he can always go for appeal. So they can make an appeal to the tribunal, and to the appellate tribunal they can make an appeal to it, and whatever the appellate tribunal decides, whether it in favor of NFRA, whether it is in favor of members, it is going to be the final one. Then we have meetings, negligible topic. Where are they going to meet? How many meetings? It's all very vague here. At such times and such places. So there is no chance of he asking an this one. And then how many employees they should have? For members, yes, there is a limit. Chairperson plus 15 members. But here we are talking about the employees. How many employees? Nothing. So again, this is a very vague one. So such other employees. So not very important of it. But this provision is important. From MCQ. Where is their head office? So their head office is in New Delhi. So just make an underline and be aware of it. Their head office is at New Delhi. Then books and accounts. Who has to maintain the books of account? Because they keep getting money granted through the budget and donated by there are various sources. Let's not get into that at this point of time. Now, whatever the money they are getting in, then who has to prepare the accounts of it? So here we are not talking about the accounts prepared by the company. We are talking about the accounts of NFRA itself. Now, then who will, what manner they have to follow, whichever the manner what the central government may prescribe. But the central government, before prescribing, they are going to consult C&AG. So they will have to maintain the books of accounts and other books in the order, in the manner which the central government is specifying, but the central government may consult this C&AG and then prescribe. Whatever are prescribed by the central government, they have to follow. Then, apart from they maintaining these books of accounts, they are also subject to audit. So, the accounts of NFRA shall be audited by whom? By C&AG. So, central government will prescribe, for which they will maintain the books, and such maintained books will be audited by C&AG. Then what do they do with that? Say, apart from these, Apart from the audit report of this C&AG, the NFRA will also prepare an annual report which they will submit it. Now, whom will they submit? They will give it to the central government. And what the central government will do, see here it is like NFRA will submit an annual report. Whom will they submit? They are submitting to the central government. And whenever they have appointed this C&AG for doing the audit, the C&AG is also submitting his audit report. This is annual report, this is audit report to the CG. Now what the CG does, the CG, they will lay both these documents, the annual report and the audit report, before each house of parliament for the review and consideration of parliamentarians. So House of Parliament, both Lok Sabha and Rajya Sabha, each house of it, both houses, they will present it. So if you look at it, NFRA submits their annual return and C&AG will give his audit report to the central government. Both of it will be presented to the Parliament, will be laid before the each house of Parliament for their consideration and necessary action. So this is about NFRA. Now let's move further. Now that is central government to prescribe accounting standards under section 133. Not very important. Now that is how our accounting standards comes into picture. Now it is mandatory, but who is making it? Who is recommending it? Who is authorizing it? Now the order that you need to see is, first ICAI will prepare this. ICAI will prepare and they will recommend, and then comes NFRA. So NFRA will review them, what has been recommended by ICAI, they will review it, and based on their review, they are going to recommend to central government. And if NFRA recommends, the central government will prescribe. And once it is prescribed, and once it is prescribed or notified, what we generally in the common language we talk about, in the legal language, once it is notified by the central government, then it becomes mandatory on everybody's part. So to summarize, how does this accounting standards comes into picture? It is the ICAI is the first one who would recommend, which will have to be reviewed by NFRA, and then based on their recommendation of NFRA, it will be prescribed by the central government. So prescribe, or as I said, notify, and review and recommend. They will recommend it to this central government. This is how your accounting standards would come into the picture. Then let's move on. This is the section 134 at your stage of this exams. This is the most important topic. You can take it 5 stars to it. This is the most important topic, but it is a very easy one. It talks about authentication of financial statements. So authentication of financial statements. Who will have to authenticate the financial statements? That is what is the point here. Now, who will have to authenticate? Let's look at the diagram so that it will be quick and simple for you. Who will have to sign? The authentication is nothing but signing. So who will have to sign the financial statements on behalf of the board of directors? One is the chairperson, if he is authorized by the board, but if no such authorization is given to him, then by 2 directors. So here there is an or, either by the chairperson or 2 directors. Among 2 directors, this is what is most important for you. So among 2 directors, one shall be managing director. So one shall be managing director and the other person can be anybody else. Along with them, CEO will sign, CFO will sign, and company secretary will sign. So I summarize again. The financial statements will have to be signed by the chairperson if authorized by the board of directors. But if it is not authorized by the board, then 2 directors. But the catch for you from exam perspective is, out of these 2, one shall be the managing director. And apart from them, there will be CEO, CFO plus company secretary. So this is the list of people who will have to authenticate the financials. Let's look at the questions. These are going to be very easy. Now, May 2020, RTPs, this 3 marks. The board of directors of Vishwakarma Electronics Limited consists of Ghanshyam as a director, Haider as a director, and Inder Sen as a managing director. always in this type of questions, he is trying to see whether you have become sensitized about this point. That is, one shall be the managing director. Since it is the managing director, anybody else can sign, but Indrasen should sign because being the managing director. And they've also got a company secretary. So wherever there is company secretary, he also must sign. Now let us look at the facts. The financial statements of the company were signed by whom? Gansham, who is a director, and Haidar, another director. Two directors have signed, but that is not sufficient enough. So, merely two directors signing is not sufficient. It should have been signed by this managing director as well. So, therefore, is this in compliance with the Companies Act? The answer is no. It is not in accordance with the Companies Act for simple reason it is not signed by the managing director. Now, let us look at another question. See, the sole purpose of this class is to make you familiar with the examination questions. Now, let us look at January 2021, which is again asked for 3 marks. What are they saying? The board of directors of this Dilip Telelinks Limited consists of, he has given one director, two directors, and then he has given Shukla, who is a managing director. So, again, the point here is you got to focus on this point. With this Shukla, who is the managing director, his signature should be there. Let us read the facts. And the company has also employed a full-time secretary, similar to the above one. So, because there is a secretary, along with the managing director, secretary also should sign it. Now, the P&L account, if you look at it, it is signed by this gentleman and this gentleman. So, who are only the directors? So, managing director has not signed. Again, the question is same. Is it in accordance with this Companies Act? The answer is no. It is not in accordance with the Companies Act. The reason being, MD signature is missing. Now, let us look at RTP again, May 2018. ABC Limited has on its board 4 directors, W, X, Y, and Z. In addition, the company has D as a managing director. Now you know, the moment he is giving you this, you need to have, again, the company also has a full time. So if you look at it, the model of the questions are one and same. All the times he is asking the same one. So because there is a managing director, D should sign, and because there is also they have a full-time company secretary, the company secretary also should sign it. So these two people should sign this financial statements. Now, so therefore here he is saying that these have been authenticated only by X and Y, whereas D is the managing director. So any two directors signing is not acceptable. Among the two, one should be the managing director. That is the point that needs to be noted. Now, but if it is a normal company, we talk about all this. But if it is an OPC, where do I have 2 directors? So that's why I may have only 1 director. So because minimum is only 1 director. So therefore, if it is a 1-person company, it is sufficient enough if it is signed by 1 director. So there is no need for 2 directors. All those are not required. Now let's move on. Circulation of financials. We will discuss much detail at a later point of time. Now, then we will move on to this board report. But to be honest with you, is not asking too many questions on the components of or the contents of the board of directors report because it is too vast. So whatever you are seeing here are the bare minimum, and in a real time board report will contain many more matters. So at this point in the CI examination, the questions are not asked much on what are the contents of the board report, but among this is important: director's responsibility statement. Otherwise, if you have a look at it, it will have the extract of annual return, it will have a director's responsibility statement, which is the most important. If at all there is a question for you out of this board report, it would be on this director's responsibility statement. We will discuss further. And then it will contain the declaration of independent directors, and wherever there are comments by the auditors and the company secretary, the board would have given their comments against it. And there are certain contracts and arrangements which are required to be disclosed in the board's report, and any amount carrying reserves paid by way of dividend and all that, conservation of energies, CSR policies, and lot many details. So any fraud reportings and number of meetings that I've handled. So they give lot of information about it, and state of affairs of the company, any loans or guarantees that have been taken. So the list goes on endlessly. And again, I repeat, from the examination perspective, you can read, but this is not an expectation. The expectation is to know more about this one, director's responsibility statement. So let's cover that. And apart from that, again, even if at all he decide to ask you a question on what are all the contents of the board report, he may ask you out of these amendments. So that is through this amendment made in 2018 and further amendment made in 2020, the requirements of board report has been widened. Now every board report must also contain the cost records that are specified under 148. So wherever this company has to comply with 148, where it requires to comply with section 148, now the directors have to confirm whether such accounts and records have been made and maintained. The same point will also be commented by the auditor and under his Coro reporting, which we will discuss it in our audit report topic. So this cost records under 148, whether they have been made and maintained. These are the words that are important. And the second amendment they have made in this 2018 is about constituting an internal compliance committee, anything relating to the harassment of women. So wherever there is at workplace, so for that they should have constituted one internal compliance committee. Have they done it? So they have to confirm through the board's report. These two are the amendments in 2018. Then moving on to this 2020, they made further amendments whereby the board of directors of a company are supposed to add these 2 points. One is whether any application has been made to this insolvency and bankruptcy code. Under this, any application has been made for declaring this company as either as an insolvent or as a bankrupt. Any application has been made. And the second point, is there any difference between the valuation done at the time of taking the loan and at the time of settlement from any banks or financials? So if there is a difference in the amount of valuation between the time when you have taken loan and the time you are settling it, going for one time settlement, they're required to disclose it. So instead of by hearting all these contents, I am just focusing from the exam perspective. Don't waste your time. Remember this. We are going to cover it a little later. And then remember these amendments. So these amendments are simple. There are 4 amendments. Cost records under 148, whether they have been made and maintained, and whether the company has maintained internal compliance committee to deal with this harassment of women at the workplace, and whether any application has been made under this insolvency and bankruptcy code, plus is there any difference in the valuation between the value that you have done submitted at the time of taking loan and at the time of going one time settlement. If there is a difference, they are supposed to disclose it. Now this is all for normal companies. Then what about OPC? Now, OPC will not have any of these contents. It is sufficient enough if this OPC will contain this explanations and comments by the board on every qualifications, reservations or adverse marks made by the auditor. So instead of disclosing all this, it will be a sufficient compliance if they disclose about if they provide their explanations or comments on all the observations made by the auditors. This is about this. Now let us come to director's responsibility statement, which is part and parcel of the board report. Now let us look at it. As I said, if at all, it's not again a frequent question. If at all there is anything that he can ask you, it is director's responsibility statement. What this responsibility statement is all about. Say, through this statement in the board report, the board is accepting their responsibility. Now, what is the responsibility? They have to confirm that yes, we are aware of our responsibilities for these things, are the highlighted ones. What are those ones? Applicable accounting and standards have been followed. And point number 2, this is point number 1, they have followed accounting standards. Second one, accounting policies have been adopted consistently, followed consistently. And third one, they have maintained adequate accounting records. And fourth one, going concern basis. And fifth one, IFCs, internal financial controls, and sixth one, compliance with the laws and regulations. So these are the points on which the board has to reconfirm that yes, we are accepting our responsibility for these six matters. That is what is this director's responsibility statement is all about. Now, then, what about OPCs and small companies? Now, because this board report has been lengthy, all along they were saying it is sufficient enough if you provide these explanations. But to increase the disclosure requirements, the central government may prescribe this abridged board report. So, with lesser details of it. Abridged, it is a condensed. So, that the central government may prescribe for this two set of companies, OPCs and small companies. As and when they prescribe it and included in your syllabus, then you may have to read it. But as of now, you may not have to focus more on those points. So this is about this board's report and the contents of the board's report. Then comes this question, who will have to sign the board report? When it comes to the signatures, generally as a student, you have to focus on this is what is more important. Who will have to sign the financial statements? Mind you, the people who will have to sign the financial statements are different from the people who are required to sign in the board report. Now, this one, just to recap it, we have already discussed who will have to sign on the financial statements, either the chairperson or two directors. Out of these two, one shall be the managing director, if at all the company is having a managing. This is must. Along with the MD, anyone else can sign. But MD signature is must if at all the company is having a managing director. Plus CEO, CFO, and company secretary. Now, let us look at the board's report. Who will have to sign the board report? Board report, who will sign? If at all there is an authorization by the chairperson, but if there is no authorization, minimum two directors, same provision. Among the two, one shall be an MD. So till here, it is the same one. But what is missing here is CEO, CFO, all the signatures are missing. The reason being, it is a board report, therefore, it only the board of directors will be signing on it. So there is no CEO, there is no CFO. And if it is an OPC, no two directors may not be possible. So wherever there is one director, such one director will sign it. So this is what the discussion is all about in 134.6, which deals with signing a board report. And there is a negligible provision. What happens if there is a non-compliance? Then the penalties can go for a company up to 3 lakhs and every defaulting officer up to 50,000. Not really important, so I have not marked anything as important. Now, let's come to the most important one. You can say very, very important. So this is very, very important. You can take 5 stars to it. This entire section 135. So which, because there have been amendments in the recent past, so considering these amendments, this entire topic is going to be important. That is corporate social responsibility. Now, going quickly to it, whenever you talk about this CSR from examination perspective, you got to keep 2 points in mind. One is section 135 and second one is schedule 7. Sorry, schedule 7 it is. So schedule 7. So schedule 7 and section 135. So these two are the most important points as far as the governance. Apart from that, you do have rules. Along with the Companies Act, you have got rules where there are rules are passed at different points of time. So I am not saying 21, 22 and all. There are frequent updations on this. But broadly, you need to remember section 135 alongside this schedule 7. Now, what does it contain? All that I will tell you. First, I will go little zigzag here to give you an actual insight as to what is this, for whom this CSR is applicable. Now, if you look at for which companies the CSR is applicable, you have to look at these threshold limits in the immediate preceding financial year. Mind you, not in the current financial year, in the immediate preceding financial year. What are all the 3 variables? Turnover, net worth, and net profit. What are the amounts? 1,000, 500, and 5. Then do we have to satisfy all the conditions? No. Any one condition you satisfy, CSR would become applicable. So I repeat, to decide whether CSR is applicable or not, you got to see what is the turnover of the company, net worth of the company, and net profit of the company. Now, whenever you say turnover, it is 1000 crores. Whenever you say net worth, it is 500 crores. Whenever you say net profit, it is 5 crores. Then all the conditions are any one condition. Any one condition, CSR would become applicable. One condition you satisfy, CSR would become applicable. Now, let us look at the questions. Provisions of CSR applicable to, he is talking about net worth of 500, turnover of 1000, and net profit of 500. Yes, all of the above, because even when you satisfy even any one of it, CSR is going to be applicable. Then look at July 2021. He is saying the balance, it is asked for 3 marks. The balance extracted from the financial statements of ABC Limited are as follows. Their net worth is 100 crore, and this is for the financial year 20, and this is for the interim financials. So provisional financials till this is till March 20, this is till September 20, that is the next first half year in the subsequently. Net worth almost the same, turnover 500, but here it has touched 1000, and net profit here it is 1, it is 5. Now he is asking, explaining the provisions of the Companies Act, you are requested to examine whether ABC Limited is required to constitute their CSR committee during the second half of the period. Now, all these limits we go by not the half yearly, we go by the annual basis. So, for deciding for 2021, we don't take the current year. This is what I was alerting you. What we go by is immediate preceding year. So, for this, since he wants us to decide for 2021, what you have to look is for 1920. If you look at 1920, all this, be it net worth, be it turnover, be it net profit, all are less than the threshold limits. Therefore, CSR is not applicable. Whenever CSR is not applicable, CSR committee also is not applicable to be formed. For simple reason, none of these thresholds are applicable. But the turnover is touching 1000 crore, but this is in the current year. But what we need to see is the preceding year. That is what the small sensitivity that you need to keep. Next one, May 2018. Look at the number of marks. It has been asked for 6 marks. Let's see how is he asking. There is a RERA Limited, a company incorporated under the Companies Act, having a turnover of 100 crore. Their turnover is 100 crore, whereas we know that for applicability of it, it is supposed to be 1000 crore. So turnover is not a problem. They are not satisfying it. And then the net profit is 3 crore. But whereas we need to have the net profit of 5 crore. So two conditions, it is less than the threshold limits. And then what about the net worth? Say the net profit is 3 crore, accumulated losses are 50 crore, and there is a security premium 300 crore. Actually, there is a little disconnect in the information that is given. They have given for finding out net worth. Generally, what do? You take the capital, then you add back your securities premium, and any profit that you add back, any accumulated losses you reduce, any miscellaneous and deferred expenses you reduce. The only thing you will not consider is the revaluation reserve. That definition itself, we'll look at it. But what about the share capital here? He has given the securities premium, and he has not given the share capital. So there is a little inconsistency in the sum. But whatever, we will approach based on the sum numbers that he has given. Look at it. Turnover he has given 100 crore. That is what we have plotted. Net profit is 3 crore. Now, which was the threshold is 5 crore. And the net worth, what all I have to do? I have to take my net profit, I have to add my securities premium, and I have to reduce my accumulated losses of this 50. I'll put both in one slide so that you can see and compare yourself. So this and plus this minus this, I get 253. But since the threshold is 500, so this is conclusion is it is not applicable. The reason being none of the conditions have been satisfied here. Now this is so like you have seen the number of questions. Now come back and push that sensitivity to yourself. So this is important because he is asking you a lot of questions on the threshold limits. Turnover 1000 crores, net worth 500 crore, net profit 5 crore. All the conditions are required? No. Any one condition you satisfy, CSR would become applicable. That is where he has been seeing. Now comes the question. What happens if CSR is applicable? Once CSR is applicable, you need to form a committee which is called CSR committee. Then, who would be there in the CSR committee? If you look at it, the summary of it, minimum is 3 directors are supposed to be there, minimum 3 directors, and out of these 3 directors, one must be the independent director. Mind you, we are not talking about the managing director like what we talked about for authentication of financial statements. What we are talking about is the independent director. I stress this word. Don't get confused. It is the independent director, not the managing director. So come back here. Once CSR provisions are applicable, you need to have a CSR committee. And the CSR committee must have 3 or more directors. So minimum 3 directors. Out of that 3, one shall be an independent director. And then what if, because since this independent director, you don't study much about this independent director at this level, so I don't want to confuse you by unnecessarily raking the topic. So let's limit ourselves to this. What is the required at this stage of your examinations? What if I don't have to have my independent director? So if there is no independent director, then all this 3 or more, this will remain the same. But if there was an independent director, he should have been one among these 3. But because there is no independent director, there is no need. There will not be an independent director. The other 3 directors will continue. But what if I am a private company? And for private company, you know that minimum directors are 2. So if I am having 3, I will have 3. But if I am having only 2 directors, the act allows me for that. Then where do I get minimum 3? That is why they say if you are a private company and you are having only 2 directors, then this 3 is reduced to 2. They said it's all right to have this CSR committee with the 2 such directors. Then what if I am a foreign company? If you are a foreign company, 2 people should be there in the CSR committee. One is a specified person and one is a nominated person. So this is the composition of this CSR committee. So to repeat it, wherever the turnover thresholds you are complying with, then you need to have a CSR committee, and this is the requirement of the CSR committee. Now, then who are all the CSR committee? The board must disclose in their board report who are all the members, who are all the committee members in this CSR committee. They are supposed to do it. What do they do? What are the functions of this CSR committee? What for we are forming it? Say, basically, they formulate and recommend the CSR policies, and they recommend the amount of expenditure to be incurred by keeping what amount to be incurred, Companies Act provisions of it. And they also monitor various projects that are being spent from time to time. So these 3 are the duties of the CSR committee. Now, otherwise, if you look at it, basically the question is very vague. Explain the requirements of Corporate Social Responsibility Committee. So you will say wherever the threshold limits are satisfied, then you need to have a CSR committee. Who could be the CSR committee members? Composition, 3 minimum directors. If you have an independent director, that independent director must be there, at least 1. If you don't have an independent director, then 3 directors. But what if I am a private company without independent director? Then 2 directors are sufficient enough. What if I am a foreign company? Then directors will not be there, but one specified person, one nominated person will be there in the composition of it. Now, let's continue with this 135. Then how much money I have to spend for CSR? What is the amount that I have to spend? This is the amount. That is 2% of my average profit. When I say average, how many years will you take? 3 immediate preceding years. This is the amount minimum, how the act starts with that. So 2% is the amount that I have to spend for this purposes. Now, look at how he is asking you. Look at the latest question, May 2022, for 3 marks, mind you. 3 marks he is asking. It's a simple one. Skip Limited, that is a company, was incorporated on 1/4/2019, and the balances extracted from its audited financial statements are as follows. So, since the company has been incorporated in 1920 and 2021, for these 2 financial years, he has given the net profit before the tax, 5 and 7, net profit after the tax. But if we come back here, we said how much CSR we have to calculate? 2% on average profit. How many years? 3 years. But here the company is in existence only for 2 years. Then what should I do? That is where it is 3 years. But if the company has been in existence for less than 3 years, then all such years. So here we will take average of only 2 years. But still the problem remains. There is he has given two net profits. Otherwise we know the percentage is 2%. But 2% of what? Is it before tax or after tax? The numbers are different. So whenever, make a note of it, whenever you are calculating, whenever you say here it is a profit, we are talking about net profit before tax. Before tax. This is the most important point that you should remember. Now, so since it is the before tax, this is what I have to take it. Once you know that, then it is simple. Then what will you do? You look at it. There is a 5 crore, there is a 7 crore, and it is for 2 years. So you average it out. When you average it, it becomes 6. Now 2% on 6 crore, which is your 0.12 crore. This will what will become your minimum CSR contribution. So that the company has to make. Now, same one he is asking in another RTPs. The net profit of the company of Neha Limited for the financial years 15-16, 16-17 and 17-18 or 1 crore, 2 crore and 3 crore. Now he is asking for 18-19, that is subsequent to this. What is the amount I have to spend? Nothing. You have to take the average of it and take 2% of it. That's all. So 2% of it. So 2 plus 1, 3, 3 plus 3, 6. So 6 when you take 2% on 2, it is 0.04 crore. It's a simple one. So coming back to it, how much money I have to spend on CSR? 2% of average profit. When I use the word average, I repeat 3 years. But what if I am not in existence for more than 3 years? I am recently started. Then take all that years average. Then when I say profit, I am talking about net profit before tax. If you remember this, you can answer all these questions comfortably. Let's move on. Then, when I know that I have to spend 2%, say for some reason I couldn't spend that CSR amount. Now, if there is an unspent CSR amount, then what are all the penalties? Say earlier, this is important because this is an amendment. Earlier, whenever I have not spent, mere disclosure in the board report was sufficient enough. They have to disclose why it was not spent, and that's all. The reason was required in the board report. But now it is not that. They have fine-tuned these provisions. If at all there is any unspent CSR amount, what the company has to do, that would depend upon, is it relating to ongoing project or is it relating to other than ongoing project? Now, ongoing project is a project which is going for multi-years. Now, you have not spent, but not that project is still going on. Let's say, just to give you this one, the company had to spend about 5 crore. They thought this is the 2% average and all. This is what the company had identified, just an imaginary figure. Now, so out of this 5 crore, because the amount is 5 crore, they thought of constructing one building, and they've identified, they started at the end of the year, and this project is going to continue for further. So they started in year 1, but the building is not complete, so it is getting spilled into this year 2, year 3. So when that activity is spilling into multiple years, that is where we call it as an ongoing. Now, if it is an ongoing, then the provisions are different. If it is other than ongoing, the provisions are different. Now, it is not that there is an ongoing, it is other than ongoing. Then what should I do? You couldn't spend within the time. Then transfer this money to a fund specified under Schedule 7. Transfer to the fund directly. But what is the time limit? Within what time? Within 6 months. 6 months from when? From the end of the financial year. So from the expiry of the financial year, that is 6 months from the expiry, transfer to this fund. If it is relating to ongoing project, because I didn't spend all that 5 crore, I'm going to spend in the next year because it's a continuing project. Then what should I do? Now, if I transfer all that money, then how will I continue my project in the next year? That is why, if it is relating to ongoing project, you don't transfer it to the fund, but you transfer it to unspent corporate social responsibility account, unspent CSR account. This account, where do you open? With a scheduled bank. So the company will transfer all. It is similar to your unpaid dividend account. They transfer to this unspent CSR account. Within what time? Within 30 days. 30 days from the end of the financial year. You transfer it to this unspent CSR account. In this account, it will be there with you for 3 years, 3 financial years. You can use this money to utilize and to complete this ongoing project. If you couldn't spend in the next 3 years, then the money will go back to Schedule 7, fund specified under Schedule 7. That's all. And within what time? Within 30 days of it. So if you look at it, summarize, if there is any, how much money you have to spend? 2% of average profit. Which profit? Profit after tax. Now, how many years average I have to take? 3 years. What if my life of the company, the age of the company itself is less than 3 years? Then you average it for all such years. Then what if I couldn't spend it? Then you have to look at it. Is it relating to ongoing project or is it other than ongoing? If it is other than ongoing, that is, you don't need this money as a continuation, then you don't keep that money with you. So then transfer it to the fund specified under Schedule 7. What is the time limit? 6 months from the financial year, end of the financial year. Now, what if it is not relating to this ongoing? That is what you have discussed. Within 6 months, you have to transfer. What if it is relating to ongoing project? Transfer to unspent CSR account within 30 days. Use this money for 3 years. Couldn't spend, again within 30 days from the expiry of 3 years, you will transfer it to this fund account. So this movement, just have a clarity of it. This amount, mind you, this unspent account has nothing to do with the Schedule 7. Schedule 7 is the fund specified under Schedule 7 is different. Unspent CSR account is different. So be on the top of this one. Now that is what when I spent less. What if I have spent more? If I spent more, again they are giving me a facility to set off this against my future liabilities. So I can set off within what? Within 3 immediate succeeding financial years. So in the next three financial years, I can use this money to offset my CSR liability going to be. Now, so if it is more, I can set off. If it is less, I have to transfer it to this funds that is specifying. Now, this point is also an important point. That is the surplus. Can you make profit? Putting it in a student-friendly language, can you make profit out of your CSR activities? Though your intention is not to make profit, but certain amount of profit may get generated. So what do I do with that surplus which has been generated out of CSR activities? It is similar to your Section 8. So can a Section 8 company make profits? Their intention is not to make profits, but what if profits are there? Similarly, here what should I do with that? So it will not become, this point is important. He is asking this in the examination. So any surplus that you are generating out of CSR activities, you are not supposed to consider that as your business profit. So you should not consider it as a business profit. Same point he had asked here in the ICAI 1. As per the provisions of Companies Act, which of the following statement is correct? Now, by reading, the surplus cannot exceed 5%. There is no such limit. Surplus can be anything. And surplus shall not form part of the business profit. This is what it is. And they say another alternatives. It cannot exceed 10%. No, there is no such limit. Neither 5 or not 10. And he says surplus shall form part of it. So he is saying it must be a form part of it. This is wrong. So therefore, this is the correct one of it. Now, then if I am not going to treat it as a business profit, if it is a business profit, I could have used it for declaring dividend and other purposes. But when it is not my business profit, but there is a surplus, what do I do with that? These are the 3 things they are asking you to do. One is plow it back. That is, use it for the same project. Wherever you have earned it, put that money, divert that money back to the project. Second one, transfer it to unspent CSR account and utilize it accordingly, whatever the time limits they have given. Otherwise, you transfer it to a fund specified under Schedule 7. You can do any one of it depending on the situation of the company. But they should not be used as a business profit. Either you push back to the same project, transfer back that money, or transfer to unspent CSR, or transfer to this fund specified under Schedule 7. What if I fail to comply any of this? These are the penalties. Upon a company, twice the amount or 1 crore, whichever is less. And on the defaulting officer, 1/10 of the amount on 2 lakhs, whichever is less, would become my penalty amount. Now, come back. So these are this CSR requirements. Now, but where should I spend this money? That is what is the question. 2%, whatever I am talking about, where should I spend the money? This summary will give you the simple background, and this he is asking in the examination. Where should I spend? I must utilize this money for spending against the activities that are listed in Schedule 7. So, the Schedule 7 specifies certain activities. So, all that CSR money, I can use it for any of these activities which are listed in my Schedule 7. Where I am not supposed to use it, which is not permitted. Spending that money outside India, spending the money on employees, take a star of it. He is asking. So I should not use this CSR money to spend on my own employees. This is basically as a social responsibility. So again, I should not use it to divert internal purposes, and I should not give it to political parties, and it should not be like a sponsorship for delivering marketing benefits. So you should not get any marketing benefits by utilizing this amount and providing water tankers with your company name, or operating a park with your company name. No, that again becomes a sponsorship. Then you are indirectly getting the benefit. No, this CSR should really go to the society. And then fulfillment of any statutory obligations. If you have a statutory obligation for any reason, you are spending it, then that money cannot be treated as a CSR activity. So these are all not permitted cases. Then where I should spend? You can spend on any activity which is listed in Schedule 7. Look at how he can ask you a question. Look at this MCQ. The Shri Limited, a company for which the CSR is applicable, decides to spend and utilize the amount of CSR for the benefit of all the employees of it. So they want to spend for employees. That is what we said. Employees, you spending on employees is not permitted. So if you have spent it on employees, then no amount spent on CSR that is how it will be. You have spent, but that will not be considered as a CSR responsibility. So to summarize, CSR money should not be spent on employees. Now, so we talked about when CSR becomes applicable. If it is applicable, I need to have a CSR committee. Then what is that CSR committee? Who would be having it? That we have discussed. And we have also covered about what if I spent more, what if I spent less, and can I make any surplus out of it? The answer is yes, though your intention is not that, but some surplus may get generated. What should I do? I should not use it as the part of my business profit. Rather, I have to do any of these three things which we have discussed, including the penalties. Then comes this question: how do I do the CSR activities? Because I am a software company. Now my expertise are in IT related field or ITES, but there is a CSR activity. I want to construct a building. Now do I have to construct myself? So how the CSR activities are to be undertaken? There are various ways. One is, if you are willing and you have the bandwidth to do it, then the company itself can spend it. Otherwise, any Section 8 company or a trust or society which has been registered under 12A and 80G, you can conduct these activities through these people. But what are these Section 8? Is it established by the company? Then you can spend it. But if it is established by others, but you want to render through this Section 8, you can still permit it, but you need to ensure that they have a track record of at least 3 years in similar activity. You can't randomly give the money to them. You have to ensure that they are capable of spending it for these purposes. So this is which are registered under 12A and 80G. Or you spend this money through any entity established under this Act of the Parliament or the state legislature. So you can spend this money through this entity which has been established through this. Or the same Section 8, same trust, same this one, but the difference is This is established by the government. Whereas this is established by private people, therefore they have asked for, they have been registered under 12A and sought this ATG exemption. So, but this is by the government. So you can use, either you can spend yourself or through Section 8, either your own one or any others. But any others, you need to ensure the track record, or any other entity which is set up by the parliament, or any Section 8 trust or a society which is established by the government. You can spend it in either ways. Now, then in the MCQ perspective, mark it here. From MCQ perspective, he may ask you about what is the CSR1. So what the central government said is, for all the entities which are carrying out on CSR activities, they have to first apply to the ROC. What is the document? Through CSR1. And once you submit the CSR1 through the MCA portal, the ROC will validate. If he believes that the CSR1 contains the correct facts, then the ROC is going to give the company what is called a unique CSR registration number. Now, this is mandatory. This is mandatory. That is what is the brief about this CSR1. And the last topic in the CSR is about impact study. So what the government felt is, when so much of money is being spent on CSR, is the money is going in the right way? So is this money being spent for the right purposes? So to do that, they say that impact study will have to be conducted by independent agencies. That is not the company certifying itself is not sufficient. Somebody should, you, when you are spending crores of rupees, is there an impact of it? What is the social impact of this? So it has to be done by an independent agency. But is it mandatory to conduct this study for every company? No. This would become a mandatory requirement only if your CSR obligation is greater than or equal to 10 crore rupees. Then I have exceeded. Then do I have to conduct this study for each and every CSR activity program? No. This, even in this case, it would become applicable only for the CSR projects which are having outlays of greater than or equal to 1 crore. So unless my total spent exceeds 10 crore, this impact study is not required. And even when it is applicable, I don't have to get this impact study done for all projects that I am undertaken under CSR. I will have it done only for the projects where my outflow is more than 1 crore rupees. Now, who is going to do it? Independence agency. Now, what do I do with that report? So, that report will be placed before the board of directors. And what do they do with that? What is the board going to do? The board will include it as a part of their annual report. So, to sum it up, these independent agencies will report to the board. They will issue, after this, they will issue the report. That report will be presented before the board of directors, and the board of directors will include this as part of your annual report. Now, when it is done by independent agency, there are some costs involved in it. Now, can I consider this cost, what I am paying as a fee to this independent agency, as my CSR expenses? So the answer is yes. So whatever the cost of this impact study, that can be treated as a CSR expenses. But the maximum is there. That is, whatever the cost that you are talking about, it should be, what is maximum permitted is lesser of these two. 5% of my total CSR or 50 lakhs. Whatever is the maximum lesser of this would become the maximum for me, which as an impact, cost of impact study, which I can show it as my CSR expenses. So this is the brief of CSR impact study. I repeat, I'll just give a brief of it. What is that impact study? Who will have to do it? Wherever the company is spending more than 10 crores, then they have to get this impact study done. Do they have to get this impact study on all their various projects? Maybe some is in construction of school, and some is like donating food essential, whatever it is, the schedules and various activities, healthcare and all that. Do I have to conduct this impact study on each and every program because my total is more than 10 crore? No. You will be getting it done only for those projects wherever the outlay is more than 1 crore rupees. Who is going to do this? Independent agency. What do they do with the report? They will issue the report to the company, which will be presented before the board. And what the board is going to do, they will attach it, they will give a disclosure of it in the annual report and circulate it to the members. Then, whatever the cost that I am spending on this impact study, what do I do? Can I claim it as my CSR obligation? Or this will be over and above my CSR obligation? Not needed. You can treat it as a CSR expenses, but with a cap, with a maximum of lesser of these two, 5% of my total CSR or 50 lakhs. So which is the lesser? That would become maximum permissible amount, which I can claim it as an CSR expenses. So with this, the entire CSR and this provisions are complete. Mind you, thus that is the most important topic, and you need to revise both section 135 and schedule 7. What is the minimum amount when CSR becomes applicable? What if unspent? What if more spent? What do we do with the surplus? How do I undertake the CSR activities? What is this impact study? On all those various matters, you need to get a good grip on it. Now let's move on. So with that, we are done with this section 135 about the CSR. Now we are moving into section 136. Under this, it says every member has a right to have the copies of audited financial statements. Let's look at the diagram. This is a self-explanatory, very simple one. What it says is, the copies of audited financial statements and the CFS and the audit report and any other document must be sent to whom? To every member, every trustee for debenture holder, and every other entitled person. Within how many days? At least 21 days. At least 21 days before the general meeting. So before the general meeting, 21 days before, they have to circulate these financial statements. Now, to whom? To the members, debenture holder, and this other entitled persons. Now, what if I am a listed company or a public company where my net worth is more than a crore and turnover is more than 10 crores? Now, these two companies will have to send this. The circulation has to be in an electronic mode. To whom I have to send it in electronic mode? To all the shareholders holding it in demat form. Now, this is not relevant because this talks about what if they are not holding in demat form. This doesn't exist because for everyone it is a demat. So, it is an electronic form. If at all it is not applicable for them, then I have to send my physical copies of it. That's all. So, in this, from examination perspective, 20 days before, what are the timelines? So this is important. Whom all I have to send this, circulate my financials? Every member, debenture holder, and other entitled persons. So these are from examination perspective, this is sufficient. But he may ask you a different question. Can the company circulate unaudited? I am writing here. So they said you have to circulate, but can the company circulate unaudited financials? Because they prepared the financials, but they couldn't get it audited. Now, can they circulate that unaudited financials? The answer is no. Because whenever you are sending financials, it is mandatory for you to attach audit report. So, if it is unaudited, you are not supposed to circulate it to the members. So, there's only one point you need to keep this in mind. Now they say you have to give the timeline. This is the timeline within which I have to circulate this. Minimum 21 days. What if I don't have that much time? There is an emergency meeting that I have to conduct. If you don't have 21 days time and you still want to circulate, then take this approval. How many people should approve? That would depend on whether the company is having a share capital or company is not having a share capital. If the company is having a share capital, not less than 95% of the people. So if they are having share capital, 95% of the capital. If they don't have the capital, voting power, say 95% is the same, there is no difference in this. Here it is the voting power, it is 95% is the share capital. So by taking their approval, I can do it. Now, do I have to circulate even subsidiaries financials? You don't have to circulate, but you have to keep it in your website. That is what they say. Your own financials you have to circulate, but my subsidiaries I'm going to keep it in my website. But what if a member wants to have it? If any member shareholder wants to have it, then I must provide. So I must provide a copy of separate audited financial in respect of subsidiaries. So my own company, anyway, it is mandatory. I have to circulate. But even subsidiaries, generally I don't circulate. I'll keep it in the website. But if any shareholder insists, then I have to send to it. What if I don't comply? Then you have to pay this company 25,000 penalty and the defaulting officer 5,000. So that is what is about circulation of financial statements. Again, I repeat, can a company circulate unaudited financials? The answer is no, you cannot circulate, because the expectation is to circulate along with the audit report. It is mandatory. Now, this also section 137, which deals with filing of financial statements with the registrar. Take 5 stars to it. He is asking questions. And mark it as important. Now, what it says is, it is the duty of the company to file this financial statements with the registrar. When do I have to file? Do I have to file draft copies? No. You have to file it after AGM. So, then what are the time limits? That is what he is talking about it. After AGM, you have to file with the registrar. But you may have various scenarios. Either you have not conducted the AGM at all, or you have conducted the AGM but the financials have not been adopted. So that is what this summary. You have conducted the AGM is held, and in the AGM it is adopted. So this is scenario 1, I will call it. You had your AGM, and in the AGM the financials have been adopted. Then 30 days is the time limit for you, because AGM has been held. Within 30 days company has to file with the ROC. Second scenario, AGM is held, but accounts were not adopted in the AGM. Members have not approved it. Then what should I do? They have adjourned it. Then within 30 days from the date of AGM, still I have to file what is called a provisional. So here I will be filing 2 times. One time as a provisional, and once whenever in the adjourned meeting they are adopting. So then after 30 days of this adjourned meeting, I will be filing. So if you look at it, here 2 times I am going to file it. See, 2 times I am going to file. One as a provisional plus final. This provisional is when this is adopted. This is the adjourned meeting. So here also 30 days. Here also 30 days. This is 30 days from when my accounts have been adopted. This is unadopted. So that is what is this timeline. So 2 times. This is what is important from exam. Even if I am not having AGM, or even if I am having AGM but not adopted, still it is mandatory for me to submit my financial statements. So then what do I do? If it is not, I have had my AGM but it is not adopted, then file it as a provisional. As and when it is approved, as and when it is adopted, then file the final one, provisional plus final. Now the third one. What if AGM itself is not held? If AGM itself is not held, then even then 30 days. So if you look at it, everywhere 30 days is the common. So within 30 days of the AGM should have been due date of AGM, to put it simple. So whether you are having AGM or you are not having AGM, within 30 days of it, you have to file with the ROC. But when I am not having AGM, how do I start my 30 days? You start counting 30 days from the due date of AGM. That is what he is saying, from the AGM which you ought to have been completed. So due date of AGM. If I am having AGM, you have adopted, then file with the ROC, adopted accounts, 30 days. I had my AGM, but it is unadopted, still you have to file the provisional, and as and when it is adopted, again you have to file final. So 2 times you are filing here. 1 time as a provisional, 2 times, second time as the final one, as and when it is adopted. But you have to file. So the only caution I want you to have here is, don't get confused. As a summary, unadopted and unaudited, these two are two different, mind you. At inter level he is not asking you Unadopted, yes, you have to file as a provisional and then final as and when it is approved. But unaudited, you don't file, you don't circulate, and you don't file. So whenever you are reading the question, 99% of the times he may not ask you, he will ask you only about AGM I had it, but it is unadopted. But for your backend knowledge, unaudited is different. Unaudited you cannot file, so he is not going to accept it. So this is what I look at this questions what he is going to ask. November 22, almost the latest one. 5 marks. Look at the marks. 5 marks question. What are they saying? The government of Rajasthan and Haryana are jointly holding 58% of the paid up equity share capital of the Moon Limited. The audited financial statements of Moon Limited for the financial year 21-22 were placed in the AGM 31st. However, pending comments by C and AG, this meeting has been adjourned. So, without adoption, they had their AGM, but it is adopted. It is adjourned. So, without adopting the accounts. Therefore, company did not file its financial statements to ROC, which is not correct. Afterwards, the C and AG comments were received, and after receiving it, they have filed the financials at a later date. So he is asking, did they comply? No. See, wherever you have had your AGM, even if it is not adopted, so you should have still filed it as provisional. And as and when it is approved, so wherever the AGM was held and where it is adopted, they should have filed the final. So the company has not done this, so therefore the company is wrong. So again, summary is they are trying to. So this side is, the second scenario is important from examination point of it. That is, you are having AGM, but accounts are unadopted, not adopted. Still, you have to file 30 days and 30 days, provisional and final. That's all. Now, with this, we are done with this concept. Now, then whenever you say filing of these financial statements, how do I file? So that is, there is a document called AOC4, now which is nothing but in an XBRL format. That is how you have to file. Now for whom this XBRL format is applicable? For all listed entities, and for all companies having a paid up capital of 5 crore or above, or all companies having a turnover of 100 crore or above, or all companies which were hitherto covered under companies filing of documents and forms. So that is covered under earlier rules. Before this 2013 Act, they must continue to file here. But this XBRL is not required. This is important for you. This XBRL is not required for banking companies, insurance companies, NBFCs, and housing finance companies. So they need not file in this XBRL format. Now, question is almost the same. He is starting itself a housing finance limited, whereas we said for housing finance limited they need not file it in XBRL mode. So let's read the question. This is a housing finance company having paid up share capital of 11 crore and a turnover of 145 crore. Now explain with reference to it whether it is necessary for them to file this financials in XBRL format. If you look at the limits, yes, they are exceeded that limits, but still, because it is a housing finance, they need not file. So the answer is no, they need not file in this XBRL format. That's all. Now, then whenever we said 30 days you have to file the financials, all that the starting point is the AGM. But what if I am an OPC? So if I am an OPC, I may not have this AGMs. So that is my starting point, the deadline for me, the timeline for OPC is not linked to your AGM. The timelines are linked to your 180 days. 180 days from when? 180 days from the closure of the financial year. So this is only for OPCs. The reason is they will not be having AGM. Then what if I don't comply with that? Then for every day of default, you will pay 1000 rupees, the company, up to 10 lakh rupees as the maximum. Apart from the company paying penalties, officers are also liable. For what? For a penalty of 1 lakh, one-time penalty. But if it is a continuing failure, then they will have to pay 100 per each day, subject to this maximum of 5 lakhs. So these are all the penalties for not complying with the section 137. Now the last topic of it, internal audit, which is dealt in section 138. So this internal audit, the applicability of it, you have to divide the companies into listed, unlisted public companies. It is public, but it is unlisted, and private companies. Once you are a listed companies, for all listed companies, having internal audit is mandatory. So without any threshold limit. But I am a public company, but I am not listed, unlisted public company. Then you go to look at four criterias. Paid up share capital of 50 crore or more, you have to remember these numbers. And turnover of 200 crore or more during preceding financial year, mind you, not in the current financial year, preceding financial year. So everywhere it is preceding. Share capital of 50 crore, turnover of 200 crore, outstanding loans or borrowings 100 crore, outstanding deposit of 20 crore. Any one condition you satisfy, internal audit becomes mandatory. And same these 2 points would come for this private companies. So because anyway they can't accept deposit, so that is immaterial, and private company cannot have 50 crore, so that is, so the turnover and outstanding same limits, 200 crore and 100 crore, this 200 crore and 100 crore. Any one condition satisfies, though you are a private company, internal audit becomes mandatory. And what does that internal auditor do, and what is that internal review of internal controls, how it happens, what are the methods that through which he will conduct, what are all the objectives of internal auditor, all that you study in your audit paper. But here it is only applicability of it. So I repeat, if you are a listed company without any threshold limits, internal audit is mandatory for everyone. If you are unlisted public company, then you got to look at four criteria. Any one condition you satisfy, internal audit becomes mandatory. If you are a private company, the turnover and outstanding would become, any one of it you satisfy, it becomes mandatory for it. Then all this you study little more in detail in your audit paper. So that's why I'm not really getting into who is this internal auditor, what is he going to do, who will appoint, who will make the payment, and can he be the same as a stat auditor. So all that I am not getting into extended discussion. Even that is not the expectation when you are learning this group 1, where he is not going to ask you all this. But this topic is an important topic in your audit paper, where you study in depth. Now, whom can I appoint as my internal auditor? Because as a stat auditor, CA in practice and only CA. So, or multidisciplinaries, where we know that point. Maximum number of partners are CAs, and only CA shall sign. But if he's an internal auditor, independence is not a real requirement. So you can appoint a CA or a cost accountant or any other professional. He need not be even a chartered accountant. Then is independence required here? As I said, independence is not required. Why do we say so? Because he can even be an employee. So he can be an employee. But as a statutory auditor, he can't be an employee, because independence is required for stat auditor, but internal auditor is not required. He can be an employee. And then he will be giving consultations to audit committee. This is the function of him. And he will also formulate the function scope, to formulate the scope functioning and all that of this audit committees. So this is what he will be engaged in. But again, I summarize, this internal auditor, you need not worry so much at this law paper, because the expectation to talk about on the functions of internal, there is a standard itself that you are going to learn, and where the direct assistance and all the technical words you will be learning. But let's not confuse ourselves. So for you, this applicability is what all that it matters. Even if he is asking here, he will ask you only for the applicability. Have a glance of it. So with this, we conclude our last segment of this accounts of companies. So as a summary, this entire chapter, considering the length that is involved in it, I have divided into 2 segments, whereby again I am taking you to just as a final summary. It's a very lengthy one. The number of sections are less, but the contents in some of the sections is very, very huge. So that is where it has taken a lot of time for it. So these two I have covered it in segment 1, which I have categorized as a segment 1, and rest all I have covered it in segment 2. And again, as I said, the whole idea of showing you this is to make you comfortable with your ICI material. Of course, we have taken our own summaries. Wherever it is required, we have taken our own summaries. So be confident of what you have learned, because whatever you have learned is through ICI material as the basis. Plus, wherever this is not very student friendly and wherever more summaries were required for a better understanding, that is where we have taken all those as a separate chart of it. So, various forms of it. So, and I've tried to include almost all the important concepts of it from examination. So, if you listen carefully, both the segment 1 and segment 2, I don't see any reason why you will not be able to score any of the marks out of this. This will become simple for you. So, with this, I will conclude my second segment, and thank you very much for your patient listening. And I'm also contemplating to release a final summary, because since it is getting into too long video now, only from examination perspective, let's make a crisp and very relevant topics for this examination purpose. That I will release it little later, but as of now I have covered it in detail through these two segments. So hope you will make the benefit of it. Thank you everyone. Thank you.